There's going to be a debate next year, and there will be growing divisions in the FOMC.
You see how diplomatic she is?
That debate's happening right now.
It's going to be like the British.
Anna Wonga-Bloomberg, thank you. Ellen Zentner at Morgan Stanley, lucky to have Ellen still with us. Ellen, do you think that breakdown in the consensus on the committee is playing out before our eyes in the statement in the news conference? Is it getting harder for this chairman to go out there and communicate a consensus that might not exist at the Federal Reserve?
No, actually, I disagree. I think there's a strong consensus on the Fed. I think that we tend to hear from the loudest people who aren't necessarily in the center.
I won't ask you who.
And we have to be vigilant in paying attention to what Powell in the center is saying, right? And they've been very clear that it has been a consensus of 4.5% to 5% peak rate. That has probably moved up somewhat, as he said.
I disagree.
And that they're going to have to hold it there for some extended period of time. That's a pretty strong view on the Fed. And it's given a lot of near-term certainty on monetary policy that wasn't there. And if you ever wanted the counterfactual of how much monetary policy uncertainty was weighing on markets, just look at what equities did on Wednesday when Chair Powell spoke.
In markets, we like to make things really simple. We throw around a single word, pivot. There's a lot more meaning behind that word for you. It's a three-part story. Can you walk us through why you break this down into three parts?
Yeah, it's a bit more nuanced. I mean, to me, the first pivot is when do they start stepping down the pace or communicating that they're going to start to step down the pace of rate increases. So that communication has happened, and so we've seen the reaction and anticipation of that pivot. The next pivot is when do they stop hiking? We think they stop hiking at 4.625%, so that's the midpoint of the range. So 4.75 for the peak rate in January. Depending on the data, it could stretch out longer for that, and maybe you do get to a 5, maybe even 5.25. But that is the second pivot, is when do they stop hiking? And then the third pivot is when do they start cutting? And we've not gotten real communication yet on when do they stop hiking. They think they know where the peak rate will be, but that's going to be the next pivot that gets market reaction.
How have we moved so quickly from an expectation of 5 to 5.25% Fed funds rate in terms of their peak rate next year to what you're looking for, a 4.6% rate, this first pivot engaged with already at the Fed?
So we've been very resolute that they would get to January and that they would get to a 4.75 peak rate. That's the top end of the range. We've seen the market make these wild swings around that number, coming down to, if you round it, 4.8% up to 5.25%, bouncing around because the Fed is data dependent, and as each data point came in, that was occurring, and it got up to 5.25%. And then what did we get? We got the first downward surprise on inflation in October, and since then, there's been a real consolidation in the view of what the Fed will do, and the Fed has been much more clear on what they think that they will do. So I think, at least for the near term, that volatility around where could the peak be has probably been diminished quite a bit.
You mentioned one pivot, then I think I heard two pivots at the table. Let's go to the triple pivot now, the hat trick of pivots. And that is Olivier Blanchard writing, a la his colleague Adam Posen at Peterson Institute, that when we come down, it is more efficacious to stop at a 3%-ish because of the word salience, which is out of VCU, Virginia Commonwealth University. Are we going out to where there's a new level that is the new 2%, if it's 2.8 or 3.2% or whatever?
So this is an interesting debate because we have, as Lisa said, we have our first cut coming in December 2023. The Fed still thinks that it will first start cutting in 2024. We have that in December 2023 because that's when, in our forecast, core PCE inflation just breaks below 3%. Because I like to point back to opportunistic disinflation, which was a Wilcox paper in 95, 96 about the Fed does not need to hike again all the way back to where they get to 2% inflation. You can set it on a downward trend, be sure you're headed there, all the elements are in place, and the next downturn can do the rest of the job for you. So you need some cushion there. And I think a cushion of 1 percentage point is perfectly appropriate.
Got 30 seconds on the clock. 8:30 Eastern time. What's the number for you and the team?
180.
180.
Yeah. I'll be happy if we're just lower than the prior month. Let's just keep the softening continuing.
TK?
Physics with Ellen, I think it's great. There's
It's
a lot
always
of
fantastic.
dynamics there
Yeah.
going on. I have huge trouble, John, getting out with the certitude of Ms. Zentner of getting out to the end of 23 or that. I can't even get out to the end of January.
So you've got to get the downshift, the step down from 75 to 50.
I had a double pivot.
Then the pause.
Is that what I heard?
And then the third piece of it is the cuts. And they've got the cuts out in 24, and Wall
I've
Street's
never
got that
heard this
further
whole
in.
pivot thing in one. It's like V-shape, way back 07.
Hey, V-shape was
Double
good fun,
pivot,
wasn't it?
triple pivot.
Thank you,
whatever.
Ellen.
It sounds like ice skating.
Thank you.
Thanks for the physics lesson.
Futures down about 1/10%. Payrolls 35 minutes away from New York City for our audience worldwide on this Payrolls Friday. This is Bloomberg Surveillance.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. We started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And frankly, when people leave 23andMe, I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. I want to build out a true consumer-empowered healthcare world, one that is outside of the existing system. And there's no greater force than government.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Do I I believe inflation is off its peak? Absolutely.
We're in an environment where inflation's not going back to zero.
The Kool-Aid is the gloom and doom.
This rally will go further, and it will probably drag people back into thinking that the bear market is over.
That post-pandemic distortion is probably going to last for some time.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Yes, a jobs day, but so much more in the coming hours. Huge news flow out of Washington, but everyone focused on the state of the American labor economy. John, you're going to talk to Secretary Walsh later. The state of labor is the jobs report, and on to, in America, a possible strike. Maybe, maybe not.
It's taken off the table. Should unions have the right to strike? Does this administration believe that? If you believe you are the most pro-union president, pro-union administration in the history of the United States, are you still, after the decision to impose this deal on workers through Congress, can you still make that claim?
In all the turmoil that we see, particularly in the United Kingdom on this as well, and it comes down to wages, and wages is the focus here that we have in 29 minutes.
For most of the street, Tom,
the jobs report.
Without a doubt, away from the headlines number, it comes down to wages. And what does it mean for this Federal Reserve? Ahead of that Fed meeting on December 14th, we've still got CPI before that. We heard from Chairman Powell, and that's really the main event so far this week. And he took a lot of weight out of the front end of the curve. The two-year yield's down by more than 20 basis points this week alone, off the back of Chairman Powell largely, as it looks like he's shifting the emphasis away, Tom, from overcooking it. And that was certainly the communication we got from him in the news conference. And I think there's been more than just a subtle shift in the last couple of weeks.
The subtle shift, Ellen Zentner down to 180,000. I believe Michael Ferroli at J.P. Morgan down to 150,000. What does the spread market say, Lisa, about the R word, not the R-starred recession?
People are staying away from high yield or not going in as much as investment grade, but still you've seen spreads come in. There's a bigger issue here when you start talking about the move you see in rates, when you start talking about the more optimism that you're seeing in equity markets, which is a stealth cutback. Is it really the headline number, or is it wages? Is it hours worked, as Drew Mattis said? Is it companies that aren't doing the same kinds of hiring plans as they have previously? And how much are people really hearing about that behind the
I said other news flow this morning here, and of course part of this is year end with the rationalization of the markets in chaos, the economics, which we're covering today, over to finance, over to investment, and then John, over to suddenly. Catherine Burton, who's been legendary in hedge fund reporting, reports that without Ray Dalio, let's be clear, this is not Ray Dalio, but his Bridgewater has had a really tough couple weeks.
So Catherine Burton's written up the story, Tom, so I'll stay true to the story and read it out for everyone who hasn't seen it just yet. Bridgewater Associates have raised most of its returns. It notched through the year's first three quarters, running what was shaping up to be the hedge fund giant's best annual performance in more than a decade. The story goes on to say the Pure Alpha Fund tumbled 13.2% in the fourth quarter through November 25th, cutting its year-to-date gain to 6%.
From 22.
According to people familiar with the matter.
Yeah, I mean, from 22 to 6, I would suggest we're going to see a lot more of this.
So what's that? Have you got caught short there as the equity market rips? What do you think's behind that?
I don't want to speculate on that, and Burton doesn't have that in the story, but I think the volatility that we have, and it's not just VIX, Lisa, it's the move, the yield curve volatility, and that what we've seen in FX as well. I wouldn't, I'd love to talk to Rebecca Patterson this morning at Bridgewater, but
yeah, good luck to anyone trying to be a macro. Good luck to anyone trying to be a macro strategist right now. Yeah. The winds shift so quickly, and they don't necessarily cohere with exactly the economic projection.
Data: the VIX through 20 closing at a 19 level yesterday, 20.29. Quick, John, data.
Equity futures right now going into this print totally unchanged on the S&P 500. No drama whatsoever. 26 minutes away from the payrolls report. Yields basically unchanged as well. Your 10-year Tom 351 euro dollar. A little bit of a stronger euro in the mix. Weaker dollar for sure over the last month. Euro dollar right now 105.35.
Chinese yuan at critical support. It's already happened so quickly here. A stronger yuan is something to look for into their Monday morning, our Sunday evening. Nadia Lovell now on this job day, senior U.S. equity strategist at UBS. Nadia, everybody's looking a whisper number down lower. If we go the other way and we get 200,000 or a higher number, what does your equity space do?
I think it's going to be challenging for equities, but what we're really also focused on is not only the job numbers, but also the wage growth, because Chairman Powell has made it very clear that non-housing services inflation is a key point of concern. And so we need to see that wage growth come down closer to something that can get to the pace of 3.5%, that would be more consistent with the Fed getting to that 2% inflation target. And so at 8:30, that's what we're watching very closely, because we don't want to end up in a sort of a wage growth spiral.
How is, I want to channel Mr. Colbert last night after he attended the state dinner at the White House. Stephen Colbert would call it growthiness. How does growthiness look into 2023?
As we look into 2023, we do expect that the economy is going to slow. I mean, we're looking for a mild to shallow recession by the time we get to mid-2023. We're also looking for an earnings recession. We don't think that the consensus is appreciating the contraction that's going to happen in 2023. We think that there's going to be at least another 10% reduction to the consensus forward earnings estimates, more closer to in line to our 4% contraction for 2023. Even that might be a bit optimistic. A lot is going to depend on how shallow and how deep and how long that recession might be in 2023.
It's amazing to see how many strategists on Wall Street right now are basically calling for a flat market over the next 12 months, Nadia. You're at 4K year-end 2023 on the S&P. Can you walk us through, Nadia, what the path to 4K on the other side actually looks like, what you think it will look like?
It won't remain flat. I think what's going to happen, what we're expecting, is that we're going to see another pullback in this market. It would be unusual for a bear market to bottom ahead of a recession. We just haven't seen that before. And so we think as we get into 2023, the market is going to really shift away its attention from Fed's action to the economic reaction. And as I said, we're expecting a mild recession. And so we are expecting this market to pull back and at least retest that 35.77 level that we saw on the S&P in October, and then sort of trend back up towards that 4,000 level by the time we get to the back half of the year, because we think by that time the Fed is going to respond to a weaker economy, a weakening in the job market, and lower inflation. We're looking for inflation to come into that 3 to 4% range, and that's going to allow the Fed to cut. And we also think that those majority of the earnings cut will be behind us, and that will help to have a more sustainable rally in the market as we head into the back half of the year and back up to that 4,000 level.
Nadia, who's buying right now?
I think what you're seeing in terms of who's buying, you're seeing some systematic buying. You're also seeing a bit of a short covering happening in the market. I think that this rally wasn't expected to this magnitude that we're seeing. So you're seeing a bit of a short covering happening. Traders are buying. But I think that once you get into 2023, it's really investors. And investors are somewhat still remain on the sideline, anticipating a better entry point in the first half of the year.
Where are they going to go, Nadia, especially given that we've already seen bonds rally pretty tremendously?
From a positioning standpoint, like we're positioned defensively within equities. Just because we're expecting a pullback in the market doesn't mean that there aren't things to do in the equity markets. I mean, look at some of the sectors that are up. The one sector that is up this year massively is energy. So if you were in energy, you made a lot of money. And we're also from a more traditional defensive position, and we've been recommending consumer staples and healthcare. We think that those are the areas of the market that's going to be more resilient in this earnings downgrade cycles. And we're also focused on quality and value.
Nadia, wonderful to get your view. Another bank looking for 4K year-end 23. Nadia Lovell of UBS Global Wealth Management.
You're off, right?
Look at these numbers. I'm going to go through them point by point, and I'll put them all out on Twitter before year-end. But here's a flavour of year-end 23. Bank of America, 4K. Okay? Next one, Cantor, 4,100. I'll give you another one, Citi, 3,900. Credit Suisse, 4,050. All right, Goldman, 4K. HSBC, 4K. JP Morgan, 4,200. Jefferies, 4,200. See the theme here? RBC, 4,100. Morgan Stanley, 3,900. UBS, basically a 4K.
Lisa, am I right that 99.28% of our guests have told me earnings are going to lowball? I think that's
Q1
huge consensus.
In early 23, Lisa, I think pretty much everyone's on the same page.
When did stocks stop being the discounting mechanism? When did they stop looking into the future?
Frustrating you this is, isn't it? I'm on the same page with you.
And then when you can't understand it, you blame the algos. This has basically been what's been going on for the past couple of weeks.
With respect,
you mean the last 10 years?
Yeah.
With respect, we aren't in the position of our good guests whose careers are on the line with these calls. I don't say this lightly, But my God, it's a one-way trade right now on weak earnings.
The problem right now is that if inflation does roll over, people expect the Fed to go back to some sort of easy money policy, less restrictive, and move quickly. If that's the case, then they could see stocks go back to rallying, and then all of a sudden valuations make sense. Try to put this together. I think that the Bridgewater stuff shows just how difficult it is to be a macro investor right now and make any call that's going to move in tandem with algos.
Just to dig deeper into the Bridgewater
things.
call, because further along in Catherine Burden's story, it does point out that Bridgewater made most of the money this year by betting on rising interest rates, a stronger dollar, and falling stocks. And what we've seen over the last couple of months is falling interest rates, a weaker dollar.
So they stayed in the trade, I guess.
And rising stocks.
We can imply that. We don't know. But
based on what we're seeing, you could perhaps read between the lines. Of course, we haven't heard
would
from
never do that.
Bridgewater because a representative from Bridgewater declined to comment on our story, Lisa.
The speed in which we have seen the dollar weaken has been dramatic. The speed in which the moves have really come fast and furious. 70 basis point move in the 10-year in just 6 weeks, 5 weeks. This just highlights, this is stuff that really is the deepest, most liquid markets that's been stable for so long. The volatility whipsawing people, pushing them out of positions and causing some of the short cover that people are talking about.
One of our interns holds a Dalio chair at Bloomberg Surveillance. Notice Rebecca Patterson will join us on Monday. Scheduled.
Wait a sec, you're calling Patterson one of our interns?
No, he's talking about...
One of the interns informed me that Patterson was going to be out there.
Oh, right, okay. Just wanted to clean
It's
that up.
a Dalio chair here at Bloomberg Surveillance.
Who's got the Dalio chair?
One of our interns. They hold it every
You've seen
year.
Bob Prince's chair? It's a nice chair.
Yeah.
It's a nice office.
It's the entourage that's speaking to us from the corners that doesn't exist.
Yeah, they are. Yeah.
Just his friends, Lisa.
They're not as many. They're a lot work from home.
No, did you not have an imaginary friend growing up?
Lisa.
I had a whole imaginary world. I think I'm in it still.
The entourage is all work from home on Friday.
Payrolls 20 minutes away.
Monday through Thursday as well.
This is Bloomberg.
Connection lost.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Jonathan just said it, less than 20 minutes from now, we'll get the latest U.S. jobs report. Traders waiting to see if it provides any clues on the Federal Reserve's next move. The job market is starting to cool off, but the report may fall short of the turning point Fed officials are seeking in their battle to beat back inflation. The median estimate says the economy created 200,000 jobs in November. In South Africa, leaders of the country's ruling party are meeting today, while the fate of President Cyril Ramaphosa is up in the air. He's said to have considered resigning after an advisory panel found he may have violated the Constitution. South Africa's finance minister says it's not a done deal.
It does not mean we've accepted that President Ramaphosa is leaving. I'm just saying in the case of that happening, we will find ways of managing it, but I don't see it happening at the moment.
There's no obvious successor to Ramaphosa within the ruling African National Congress. The Pentagon is reportedly considering a major expansion in training for Ukraine's armed forces. According to the Washington Post, the plan has been discussed for weeks by Defense Secretary Lloyd Austin and other top U.S. military officials. It could lead thousands of Ukrainian troops to be trained by U.S. forces at a base in Germany. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We have more confidence that this rally will continue. We think rates will go lower. We think, Powell's commentary is right in line with what we've been saying, which is that they're going to pause probably in January. The market's getting in front of that, and this is a classic, kind of Fed pause stock market rally.
Mike Wilson there of Morgan Stanley. I've got to say, this call from Morgan Stanley, listen carefully to that. Pause in January, Tom. Not step down from 50 and go another 50. They're saying at the start of 2023, and Alan Zentner indicated that's where they're going. They think you get a pause that early in the year from this Fed.
You want to do a watch here, folks, and I'll tease forward to John's effort at 9 o'clock. You want to listen to Mike Wilson yesterday from Morgan Stanley, and then you have Rick Reeder on. Am I right in the 9 o'clock hour?
And Mohammed too.
And Wilson and Reeder together on this market in the next 6 weeks. Forget about this. The navel gazing out 12 months. I'm with Bridgewater. I mean, just getting out 90 days, as they've struggled with, is half the battle.
This call Mike's made, never mind about the bearishness through 2022, the call to get bullish and get behind this bull market rally in the way that he did in the last month. And it's continued through this week.
I go back to revenue analysis, and I'm sorry, the nominal GDP number is good. And granted, some people pushing against me on that. We're coming up on Jobs Day in 12 minutes. Let's get right to it. I'm going to do one question here to the former governor of the Federal Reserve System, Randall Kroszner. He is at the University of Chicago. As Charles Evans steps aside at the Federal Reserve System of Chicago, and a surprise announcement for so many, but not to Randall Kroszner, his colleague, Austin Goolsbee, will join the Federal Reserve team. Randy, I don't want to take a lot of time here. It's something you and I would do for 1 hour on Bloomberg on the economy. This is a guy who wrote the Intermediate Microeconomics Policy Bible with Steve Levitt of Freakonomics and others. This is a guy steeped in microeconomic foundations. What will Goolsbee microeconomics mean? What will that voice mean to the Fed?
I think you can see from his comments before getting out to the Fed that he's emphasized the supply side of the economy, really focused on that, and said, well, maybe the Fed shouldn't be doing quite as much because it's really a supply issue and the Fed can't directly address that. We'll see if his views evolve, but he's really focused on the supply side of things.
How do you really game out the supply side when China and the reopening is the big question mark for next year?
Well, that's one of the challenges that he'll be having at the Fed, but that's, of course, one of the issues. Are we going to see a whole bunch of changes that will relax some of the supply side constraints? But also, at least from my perspective, you can't forget about the demand side because the price pressures come from where supply and demand come together. And obviously, the Fed does have an impact on the demand side.
What are you seeing right now that perhaps the market is not in terms of the stickiness of inflation, of whether we have seen peak inflation, of just how quickly it can come down?
So I think it's likely that inflation is going to be heading lower from here, but I'm not so sure it's going to come down so quickly, particularly for core inflation. One of the reasons for that, well, I think there are two reasons, and Jay Powell mentioned both of them. One, you've got rents starting to move down, but the way rents come into the shelter services part of the price indices, it's not just today's rents, but also over a number of months. So that's going to be somewhat slow to come down. The other part that's really relevant for today is he's worried about services. He's worried about the strength of the labor market. And as I've been saying with you for the last few months, the Fed's going to keep at it until they see the labor market crack. And I think Jay really talked about that, said if the labor market continues to be hot, wage increases continue to be high, it's going to be very difficult for inflation to come down, and I think it is going to take a little while.
So, Randy, did you see a real shift in tone, though, at the Brookings Institute with Fed Chair Jay Powell, where perhaps he was less willing to stick with it, less willing to go all the way to 5 and hold it there?
Oh, no, I didn't hear that at all. I think what he wanted to get out was that they're not going to do 75 basis points every single meeting forever. And I think it was pretty clear in the markets, I think already had largely accepted that they were probably going to do 50 at this meeting, and then we'll see how inflation evolves. I think they're going to continue into the mid-5s. I think they will end and pause with a 5 handle. But I don't think they're going to stop in December and just hold it, right just below 5 or right around 5. I think they'll probably go into the 5s, and that's probably where they'll hold it. And then I think they're going to hold it for a while because I don't think inflation is going to come down unless there's some sort of shock from Mr. Putin or from some other geopolitical.
Randy, I want you to speak to Global Wall Street on this Jobs Day, 7 minutes away. I want you to do some Brown mathematics, some Brown algebra. And there's a Greek letter on the right side of the equation, which is called epsilon, which is this massive uncertainty that's out there in every Krosner-like study. Have you ever seen uncertainty like this?
Yeah, and I think the way it's manifest is you see incredibly strong movements in the markets from just small changes in information. So, a couple of weeks back when we got a slightly better inflation report, markets took off like a rocket. Now, that's one data point. It was just slightly different than had been expected. I think that shows that the markets are really quite skittish, and they jump a lot when there's just a little bit of information getting at that epsilon, a lot of uncertainty.
Randy, you're going to stick with us and break down these numbers when they come out in about 7 minutes' time. I've got eyes on Mike McKee, which usually means something big's about to happen, Tom. Mike McKee's in the studio.
We
hey,
hope
Mike,
so.
Great to have you with us. Let's go through these numbers together. 200K is the median estimate in our survey. How big's the range? What are you looking for?
The range isn't very wide this time, and there's a general concentration around 200,000, but maybe it skews a little bit to the downside, and the whisper number on Wall Street, according to the function on the Bloomberg, is 188. So maybe the folks who've raised the idea of what do we do if it's too small? You were talking about that earlier, Tom. That'll be the question for Wall Street to answer.
What about wages?
That's going to be the big issue. And Jay Powell made it that way on Wednesday because he said service industries at this point are the ones that are still having to pay up. So we're going to watch and see whether service industries wages are still rising significantly, and then the impact on the overall average hourly earnings.
We've seen savings come down dramatically, but we see spending continue to surprise to the upside. When you speak to economists, when you speak with Fed members, are they surprised by how quickly people are getting ahead of this disinflation, softer labor market type of story?
Yeah, I mean, the old theory is that inflation's bad because people will spend money today, before it becomes worth less in the future. I don't think consumers think like that. They're not saying, well, this is going to cost a lot more, so I'm going to go out and buy a dress today. But it might, maybe with a car or a house. But at this point, there was a big cash cushion that people had coming out of the pandemic. They're spending down out of that. We're seeing credit card usage start to rise. It's still not where it used to be, but people are spending more on credit. And it kind of shows you the will of the American people is to hang in there. You know, don't stand between an American and a cash register, as they say.
That's the way to
Retail
say it.
sales were up 7 or 8%.
The resilience.
Thanksgiving, Cyber, Black, and all the rest of it.
Interview of the week so far, Neil Dutta, Renmac, without a doubt.
I agree. I
Sat
agree
in
with
Mike's
that.
chair.
It's the first time you and I have agreed.
Of the US economy.
Like,
It's our anniversary.
It's our anniversary.
We're going through couples therapy, Mike. It's very emotional.
I'm sure Lisa doesn't. Do you accept insurance for this couples therapy?
We're very
You think I'm therapist? No, I'm going to go watch the World Cup.
Our copay is about $25 each. Bramo charges. What's the hourly rate now?
$350.
$350 to sit with us for an hour.
Oh, it's probably
You should demand more than that. Payroll's coming up. It's 5 minutes away. Your
Inflation.
estimate is
Did we
200K.
break like 3 HR rules there?
This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Payrolls Friday on Bloomberg Surveillance. The data seconds away. Going into it, equity futures negative 0.2% on the S&P 500. Yields lower at the front end by 3 or 4 basis points. With your economic data, here's Mike McKee.
Well, the whisper number was wrong, John. We got 263,000 jobs created in the month of November, so a significant beat to the upside. Even the forecast was 200,000, and that puts us at this point ahead of. I'm just looking here for what the revised monthly October number was, but it was 261, and the change for October was revised up by 23,000 from 261 to 284. So yeah, job growth slowed, but it was a lot faster back in October than we thought. The unemployment rate is holding steady at 3.7%. That's what everybody cares about. That 100,000 job loss in manufacturing in the ADP report does not translate. 14,000 jobs created in manufacturing. Earnings, this is the one Lisa and I have been looking at, up 0.6. That is stronger than anticipated, stronger than the 0.5 in October, and that pushes up average hourly earnings year over year to 5.1%. 5.6% is actually the revised number for October, so it's a decline, but it's significantly higher than it was in the initial report. I'll give you the labor force participation rate. It drops to 62.1. Jay Powell said kind of that is not something they're as worried about as they were in the past, but I'll bet you, John, that wages number has got Wall Street's attention.
Oh, Mike, this one's easy to interpret, isn't it? Equities down, lower, negative by 1.4%, negative 1.5. If you want to round this one down on the S&P 500, futures softer, yields higher, much higher, by about 10 basis points to the front end on a 2-year, back to 432, on a 10-year up 9 basis points to just south of 360. And as you can imagine, with equities down and yields up, the dollar stronger, dollar index, Tom, up by 0.5%, upside surprise on payrolls, upside surprise on wages, equities down.
What a great day to have Jeff Rosenberg with us and Governor Krosner with us. And Mike, I know, is diving into the data. I got 2 quick comments. My quick calculation of the 90-day, 3-month moving average, including revisions, don't hold me to this, folks, but I believe the statistic is 280,000. And the others, can we have a moment of silence for Ben Emmons, who nailed this an hour and a half ago?
So let's get some perspective. 433 on a 2-year. That is about 50 basis points lower than we were in the immediate aftermath of the last payrolls report. So, Mike McKee, can you walk us through how the Federal Reserve conversation has reset over the last month and what you think these numbers might mean on December 14th for the next decision?
Well, it kind of fits the narrative that we're still seeing a strong economy, so the Fed has to do more. The question is, how high do they have to go? And that was the emphasis that Powell put on it. If we don't see wages start to come down, then we're going to have to keep going up until they do. They need to be in the 3 to 3.5% range in order to be compatible with a 2% inflation rate. So at this point, wages are still a problem the Fed has to address. Now, it doesn't mean that they have to go 75 basis points. I don't think that changes this calculation at all, but it does probably move Fed funds futures out into 2023 with a little bit more of an increase priced in until we see some sort of change here.
Why was the whisper number so wrong? Why are people so confident that there is going to be some massive deceleration that just keeps not coming?
Well, you don't know exactly what people on Wall Street are thinking, but we did have the poor ADP report, and we had the ISM manufacturing report come in showing there's still contraction in payrolls, and there's generally been a lot of news about layoffs and planned job cuts, mostly in tech, but certainly we've seen over the last week, news media. So probably that all got absorbed into people's thinking about what was going to happen. We've been cautioned by a lot of CEOs that things are not as bad as they seem out there. And also remember how hard it's been to hire people. And so they don't want to let people go.
My head's spinning here. John, what's the market statistics that got your attention?
Yields up at the front end by 14 basis points.
Yeah.
Trying to get back to the levels
advancing.
Trying to get back to the levels where Chairman Powell spoke earlier this week, because Chairman Powell took a lot of weight out of the front end of the curve a little bit earlier this week, Tom.
And for the curve inversion, we're watching to negative 76 basis points, real yield up, but we'll go through that in a moment. The guests are too important right now. Randa Krosner with us, Professor Krosner of the Booth School, Chicago as well. Randa, you and I can talk about the algebra standard error. Forget about it. Do we have any understanding of the veracity of our statistics given the new America, the new technology out there? Are we making this up as we go, or can we really guesstimate forward with some good faith?
I think we have reasonable insight into that. But of course, as you said, there are a lot of changes. Things are new. We're bouncing out of a very unusual period with COVID shutdowns. So of course, there's uncertainty that's there. But I think as we were talking about before, and as I'd said before, the Fed is going to keep at it until the labor market cracks. The labor market has not cracked. Wages are still going up at a very rapid clip. And the Fed can't stop until the labor market starts to slow down, because otherwise you're going to see wage inflation continue strong. You're going to see services prices continue to go up. And so they're going to keep at it. And as I said, I think they're going to keep at it till they get at least until the mid fives in the next year. And Jay is hoping, and he talked about this, what I call an immaculate disinflation. That is, could we bring the inflation rate down without having a significant rise in the unemployment rate? The only way they can do that is if wages start to come down, if more people come into the labor market, if demand starts to come down. We haven't seen that yet, so it doesn't look like an immaculate disinflation. Interest rates are going to have to continue to rise.
Fed Chair Jay Powell pointing to accelerated or brought forward retirements as a big driver of why we are not seeing the participation rate go back, why people are not coming back into the labor market. What did you make of his comments around that this week?
Well, I think, that was his hope that maybe if there's more supply coming into the labor market, that'll help to take some of the heat out of wages. Well, we're not seeing a lot of evidence of that now. And he was sort of hinting at, I was hoping for that, don't really seem to see it. So the only way that we can do this is to have slowdown in demand that'll slow down the demand for workers and slow down those wage increases. He's still hoping, but we've never had an immaculate disinflation before. I don't want to say it's impossible, but it's I think it's not very likely.
Randy Krosner with us, of course, of the Booth School of Chicago. In moments, Jeffrey Rosenberg will join us as well from BlackRock. We welcome all of you on radio and television of the shock of this jobs day. Futures at -61, as John Farrow mentions. 2-year yield exploding out. John, and a cup of coffee, a sip of Tang, we've gone from 14 basis points out to 17 basis points higher 2-year yield.
Back to 440, still below the highs of the week, but back to 440. And with yields up at the front end, Tom, as you can imagine, equities down, futures lower by 1.5% on the S&P, and the dollar stronger by about 0.7% on DXY.
To see this, folks, we're all wired in, but none of us is wired in like Michael McKee. He is looking there at the BLS data. I'm looking over just because I can attest. I'm going like this.
Trying to see what I'm looking at.
What is the single data you see in the pages that you go through?
Well, I'm just trying to do the math here. The interesting thing about the hiring here is you might not be surprised that there were 20,000 construction jobs added. We've got a lot of rebuilding to do down in Florida. But what month is it? It's November, and we lost jobs in retailing, 30,000 jobs lost in retailing. That just seems very odd to me that we don't have as many people doing the retail work at holiday.
Is that Amazon? The cuts there by Mr. Josie?
It could be. I can go back and look here. One of the things you want to look at is the under transportation, warehousing, and couriers, and that couriers and warehousing were down 12.4 thousand. So at this point, it's kind of hard to see.
Amazon made a lot of hires in that world, but in the last couple of years.
Yeah, I mean, but they don't seem to have added a lot of people, and that's kind of a little strange. You have to dig into that a little bit further.
We'll do that in about 20 minutes' time. Mike McKee's going to break down the jobs numbers for us as we go towards the opening bell. Then we're going to hear from this lineup. Fantastic lineup going into the open. Mohammed Al-Erin of Bloomberg Opinion, and a whole lot more. And Rick Reeder of BlackRock. Then we'll hear from Anastasia Amoroso of iCapital, Mike Collins of PGIM, and you'll hear from Secretary Walsh, Tom, responded to these numbers at about 9:45 Eastern Time.
Maybe our most important conversation with the Secretary of Labor, given the railroad theatrics of America, harkening back to 1946 and 1877. Thank you so much, Randall Krosner, for being with us today. And now we bring in, really at a telling point given bond market movement, Jeffrey Rosenberg joins us now from BlackRock. Jeff Rosenberg, I look at the volatility and I don't want to equate it over to the news on Bridgewater and their challenging fourth quarter. How do you run fixed income money right now? I don't have a clue.
Well, you know, one of the biggest challenges is what we're seeing in the reaction to this surprise to the upside, and particularly, as you guys have highlighted, it's the wage data that's driving it. But what you see is stocks are down and bond yields are up, and that's the kind of correlation, a positive correlation in terms of both going down at the same time that is so challenging for investors. And I think it's a reminder, you know, what we learned from Chair Powell in the speech earlier this week is that the most important determinant for inflation going forward is going to be the services component. And what drives that services component is wages. And so what we might be starting to get a hint of here, and it was in a little bit of the earlier conversation, inflation's coming down because of all those underlying components, the supply side, the goods picture, the discussion around the lagged impact of housing. None of that matters. What matters is a wage price spiral. And so this upside surprise
You're going to bring that out today, Jeff?
What matters is this wage price and what we're seeing in the wages, and so I think that's the most important takeaway. And the challenge, to get back to your question, is that inflation really undermines the relationship between stock bond correlation. So we can't get back to that until we settle this.
I'm busting Jeff Rosenberg's chops. This is what happens when you study with Meltzer and good friend at Carnegie Mellon. You start talking about a wage spiral.
He has a point, though, Tom. Let me just jump in here quickly and tell you, I did the calculations. Private service industry jobs, wages were up 0.8%, while goods producing jobs were up 0.4. So what Jay Powell said about service industry jobs driving wages higher because they can't find employees is definitely showing up in the wage data, it appears.
Which composition really raises a question as well. And Randy Krasner, I'd love you weighing in on that, whether there's a compositional aspect where people on the higher ends are getting hired and there's a shortage, especially with the retirees, and on the lower ends, perhaps it's a different picture. What's your sense of how much that's contributing to the unexpectedly high rise in wage inflation? Jeff Rosenberg, what's your sense of that? Excuse me.
Sorry, I thought Randy might have been off, but I'll take that. Yeah, you always have to look at the compositional effects here, and certainly there may be some of that, as Mike highlighted, with the retail numbers down and the warehouse numbers down, and Mike, some of that can be seasonal, so that's something we'll have to look in. So there is definitely, when you look at the high frequency data on a month-to-month basis, you can get a mixed shift, and that may be pushing up this number, this 0.55 number. Nevertheless, you know, the bigger takeaway, if you abstract, if you smooth out from the monthly variations, is that the 12-month run rate of wage inflation is still above 5%.
Right.
And so this is really the challenge. And so we're going to get away at some point from this debate about 50 or 75 or really the pace. And the issue is the level of rates restrictive enough? That's really going to be the debate, because right now in the bond curve, the market is expecting rates to be cut by the second half of 2023. So there's a real disconnect between an expectation that we can see the Fed have success on inflation, so much so that they can turn and start cutting rates, versus what we're seeing in the data today, which is none of the impact. Now, there's long and variable lags here, so that
we've seen such incredible volatility on the backs of some of these numbers.
Yeah, you know, we've seen sort of a rolling sequencing of kind of smaller fires. It's sort of like the analogy, small forest fires prevent large forest fires. So I think some of that is helping to ease some of the broader concerns. I think the other thing is that there's an anchoring to the global financial crisis as sort of the metric of what does a liquidity crisis look like. And that was a very particular one. Mm-hmm. And we've done a lot of things to mitigate that type of event from happening again. So the centerpiece of a liquidity crisis doesn't necessarily flow through the regulated financial markets. What we saw in the UK with the LDI crisis earlier this fall, is exactly this point. So you have seen some of those implications, and you know, I think we'll continue to see these kind of smaller forest fires as opposed to the big fire.
Jeff Rosenberg, thank you so much at BlackRock. Really, really appreciate it. Just a really exceptionally interesting and nuanced report to summarize not only the job statistic, better than good, better job formation, but the revision the same way as well. Futures deteriorate, -65. Dow futures, -433. The VIX, I don't have a good VIX number right now. Oil doesn't give me much, but the bond market was up 17 basis points on the 2-year yield, a higher yield. We're now up 14 basis points as well. I want to get Mike McKee in here before we go on bonds to Ira Jersey and Gina Martin Adams on the equity market. What do you see on page 47 of the report?
Well, we didn't even talk about the factors behind the unemployment rate, which are kind of a little weird here. A household survey can be very volatile, and it shows 138,000 jobs lost in terms of the number of employed, and the unemployment number of people who were unemployed went down by 48,000. So there were fewer unemployed, but more who were not employed, and the labor force fell by 186,000. And this is the time of year when you would expect the labor force to have increased, even with seasonal adjustment factors.
And this is again because of retail.
Because of retail, we do have one of our most loyal viewers has written in and suggested that it could be that employers have been hoarding workers, so they didn't need to hire as many seasonal workers. Or it could be, and I'm going to be very interested, people who follow this stuff really down to the minute level. I'll be interested to see, Goldman had a thing on jobless claims the other day suggesting that claims are overstated because they changed the way they did seasonal adjustment for the pandemic. And I wonder if that may be affecting holiday hiring here, because the numbers during the pandemic didn't compare to previous.
Michael McKee will continue this discussion with us through the next hour as well. Again, futures -62. On the bond market, Ira Jersey joins us. He is with Bloomberg Intelligence, driving forward our U.S. interest rate strategy. Ira Jersey, how does Chairman Powell's world change with this shock report?
Well, I think that the Fed has to be, less balanced. So over the last couple of months, the Federal Reserve has become more balanced in that, yes, it's still talking very hawkishly, but it's also saying, like, hey, we don't want to go too far. The Chair Powell said that just a couple of days ago. And I think with a report like this, you have to be very concerned that you are going to get, Jeff Rosenberg's wage price spiral, right? And because of that, maybe you only go 50 basis points in December, and I think that that's still the base case. But the market now is starting to price, and I think that this is right, that maybe the Fed is going to have to go 50 again in February. And because you wind up with still a faster than expected rate of increase in the Fed funds rate, that means you're going to get just more flattening of the yield curve, additional inversion, and pricing for a harder landing, quite frankly.
Lisa, how can you have a wage price spiral if after adjustment for inflation, everybody's paycheck is getting smaller every week, every month?
That's the
reason why. It doesn't make sense.
But this is the reason why people are going to their employers and saying, look, we need to get paid more, or we're going to do early retirement, or we're going to basically bow out of the market and take care of our kids. There are structural issues here, Ira, that are leading to the participation rate going lower and wages going higher. You said that the market is starting to game out 50 basis points in February, too. Is it? Because right now the market feels all over the place with just one weaker than expected print on the CPI, suddenly shifting everyone back to 4.5% peak funds rate.
Well, I can tell you right now the market is pricing for now a 50-50 shot of a 50 basis point hike in February. So that was almost zero at the beginning, before this data. So that is what the market's pricing. I would say one of the things that's interesting is that even though you've had such a strong report, when you look at things like overnight index swaps or the Fed funds futures curve, we haven't gotten back to where we were a month ago, right? So we're still not pricing for a 5.25% terminal rate by the Fed. And I think that ultimately over time, if you have some other data that kind of concurs with this payrolls report, that we wind up probably getting back there at some point. Because I do think that the Fed is going to hike to above 5%, which means that 2-year yields are probably still 30 or 40 basis points too low. Tom mentioned that we've rallied about 50 basis points on the 2-year yield. We're going to undo most of that, I think, if the data continues to be as strong as this today's morning's report suggests. suggests.
I take your point, Ira, and it does seem as though this data set was of particular importance. Jason Furman of Harvard University, formerly one of the economic advisors to former President Obama, put this tweet out just moments ago on Twitter. You probably want to revise your views on inflation and its overall dynamic more based on today's jobs report than any other data report this entire year, and not in a favorable direction. Ira, is there this sense that this jobs report changes the scenario for you and changes the scenario for others?
Well, like everything, we have to say this is one report, but it is I think it is pretty meaningful, because when you look at some of the other data, like you look at the ISM manufacturing employment numbers being negative, we do need confirmation of this, right? So let's not get, I wouldn't get as overly excited as that tweet suggests, but at the same time, we'd have to look out, and I think the risks are rising that if we do continue to have very strong payrolls and wage gains, that the Fed is maybe even have to go beyond the 5.25 that Bloomberg Economics thinks that we're going to have to go, and that can have again very significant implications for the rates markets.
Ira Jersey, thank you so much. Greatly appreciate it. We're going to continue here. Gina Martin Adams with us here in a moment on Bloomberg Intelligence equities in the stock market and a wonderful new index. Mike McKee, off of Rosenberg's comment on wage spiral, I did a moving average study of average hourly earnings back to the nadir of 2012-ish. Wages are up 154% year over year, from a very low level of about 2% wage growth, and we've ballooned up to 5.1%. In the literature, is that a spiral?
I suppose you could count it as a spiral, but from 2012 to 2020, wage growth was very, very slow. So what you're really getting is the last couple of years are pushing that number up. And I think the Fed knew that was going to happen, knows that's going to happen, and that's what they're pushing back against right now, and saying they're going to have to, as Ira was saying, raise rates maybe farther to bring down the wage gains. I think what is most important to Americans is if you did the calculation for what CPI has done since that time period and measured what they got to pay, because everybody's falling behind.
The best. Michael McKee, thank you so much. On to John Farrow and also what we do on radio here in the next hour. Gina Martin Adams saves the day. She knew the triple leverage all cash fund was the right equity position here off this equity report. Gina, congratulations on the splash of the Bloomberg Intelligence MVP portfolio. This is really, really cool. How will the MVP portfolio do in a buoyant American labor economy?
It generally should be pretty well positioned, considering that value is one of the key factors of the MVP portfolio. Recall, we combine momentum, value, low volatility, and high profitability companies to come up with our list of 50 stocks within the S&P 500 that are pretty well positioned on a risk-return basis to perform well. And the portfolio's performed well throughout various types of economic climates. But considering that value is one of those key factors, value stocks tend to perform best in periods in which inflation is accelerating. So steady inflation signaled by the wages component of the employment report from this morning would generally suggest value should perform reasonably well. That said, this portfolio is generally designed to help identify stocks that perform best throughout time and in various climates.
Gina, we've been talking all morning about how everybody right now is bearish on stocks in the first quarter, but still bullish right now. Today, we're seeing perhaps a bit of a shift in tone. What do you make of this in terms of who's out there buying now versus all of the people who are giving recommendations against that exact trade come early next year?
Yeah, I'm frankly not quite sure what to make of it, Lisa. I think a lot of it is about market timing, and certainly you have a bunch of cross currents with people thinking about, what's going to happen over the next month versus over the next year at year end, which creates a lot of confusion and commentary and interpretation of narrative. Our view is, look, stocks do look a little bit vulnerable to correction going into year end, if for no other reason than just tax loss harvesting. What you tend to see is fairly muted returns toward the calendar year turn after an environment in which stocks have struggled throughout the year, and that certainly has characterized 2022. Also, small caps have lost a little bit of momentum here, which would hint to us that we're due for a bit of a pullback in large caps, and this is all information we published yesterday in our chart book report. So I do think we're poised for a little bit of a pullback here into year end. And then into 2023, it really, once again, is all about the fundamentals of will the Fed actually get to a point where they feel satisfied with the disinflation that is likely to occur, and can they eventually pivot versus we're in an earnings recession. And the market is really struggling with this right now because the market keeps just desperately sort of clinging to that notion that the Fed can pivot. And none of the data would suggest the Fed is likely to pivot anytime soon.
On the
So we're
flip
going to
side,
be in this sort of volatile climate for a while.
Gina, just quickly here, on the flip side, could people say perhaps earnings are going to be better than people are currently saying in the first quarter because we are seeing those hirings, because we are seeing those wages being paid, and that earnings are not going to come down as much as some people are suggesting?
Yeah. Doubtful, Lisa, because employment is not really one of the best drivers of earnings growth over time. I think employment certainly is a key factor for the Fed to watch, certainly is a key factor defining economic conditions broadly. But when we look at the factors that really drive earnings growth for the S&P 500, single most important factor is durable goods orders. Secondly, you've got commodity prices. Thirdly, you look at the long-term trend in the unemployment rate. We're not getting improvement in the unemployment rate anymore. We're also not getting deterioration. But the fact that you're not seeing improvement in the unemployment rate is actually on net not a positive for earnings growth. So you want to watch those other factors as more important macro factors that drive earnings. But frankly, the macro is not the whole story either. This is really about margins.
Gina.
And will companies be able to cost cut into a better environment next year?
Gina, thank you so much. I'm sure we'll speak next week as well. Gina Martin-Adams with us with Bloomberg Intelligence Equity Operations as well. Lisa, on the survey screen, 270 was the high estimate. What an odd report. And Ben Emmons with his note an hour and a half before the report, I thought was shockingly prescient in terms of the mathematics that gets you to a high estimate. Stephen Gallagher at Societe Generale, David Kelly at JP Morgan absolutely nailed this. Ian Shepherdson, when he wasn't watching Newcastle football, nailed it. And and there's others as well. But it's just, did we know that we would come in and swing like this from the whisper?
Clearly not, based on what the market's doing. But it's not just that, it's also the revisions. Everything went up, including in wages. That's really what stands out to me.
A quiescent market off the shock. We were futures negative 60, negative 70. Now S&P futures at negative 55 as well. An eventful Friday. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Brace yourself because I know you hate it. Good news is bad news. Live from New York City this morning. Good morning, good morning. Equities heading south as payroll surprise to the upside. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Farrow.
From New York, we begin with the big issue. It's Jobs Day in America.
The jobs data?
This month's employment report. This surprise to the upside.
The story for 2022 has very much been one of the Fed and rates driving equity markets.
We're all subject to the data.
It's payrolls, it's CPI, it's the Fed into year end.
How the Fed reacts to all of these numbers.
But we want softer jobs. We want softer jobs.
The Fed is slowing the economy down. That's exactly what it's trying to do.
The Fed can't stop until the labor market starts to slow down.
We heard from Powell. They're going to moderate the pace of hikes going forward.
The Fed is going to look through it if it's a very strong print.
The labor market has not cracked.
What you see is stocks are down and bond yields are up.
Wages are still going up at a very rapid clip.
It's the wage data that's driving it.
We are not getting softer jobs. Mike McKee joins us now for more. Morning, Mike.
Yeah, John, it was a surprise to the upside, 263,000 jobs created, which is actually a decline because October was revised up from 261 to 284. So the last 2 months has seen more strength in the labor market than anybody anticipated. We do see 3.7% as the unemployment rate, same as it was the prior month. The participation rate drops a little bit. I'll get to that in just a second. But everybody in your roundup there was focused on the same thing, wages. Average hourly earnings up more than anticipated and up at a 5.1% rate, which is higher than the 4.9% in October, the revised number. So we're still seeing wage gains, and that's what the Fed doesn't want to see. Now, you can see here on the chart, some of that is base effects, but they should be going down now because the base effects in the most recent months are for lower inflation. And then you look at where we are, we're way above it. The green there is where the Fed would like you to be, between 3 and 3.5%. So 5.1%, still way too strong for Jay Powell and company. The numbers are showing it's the goods versus services wages. Powell was talking about services wages. Well, they were the ones that were up significantly during the month. They were up by 7%, almost 8%, whereas goods producing only 0.4%. So this is kind of exactly the story that Jay Powell described the other day when he said that service industries are the inflation problem right now. The interesting thing about the unemployment rate is that we saw the household numbers decline. Employment declined in the household numbers, but 186,000 people left the labor force. Not what you would expect around the holidays, maybe a seasonal adjustment problem, but it does suggest that there are still going to be job openings, a lot of job openings, according to the JOLTS numbers, and we're not getting the workers in the labor force to fill those. I note that the president is going to speak later this morning on the Railroad Act. I'm sure he's going to talk about the economy. He does have something to brag about, and that is for Black Americans, Hispanic Americans, and Asian Americans, the unemployment rate all went down significantly. It was only white Americans, and in particular, those without high school degrees, who saw a decline.
Mike McKee, thank you. We'll catch up with Secretary Walsh on some of those themes in about 40 minutes' time. Let's push that data through this market. Equity futures down by 1.5%. Equities down, yields up by 12 basis points to the front end. Your 2-year 435. Dollar stronger by 0.5% on DXY, back through 105. Joining us now to discuss, fantastic lineup this morning, Mohammed Al-Arian of Bloomberg Opinion, and of course Queen's College Cambridge, and BlackRock's Rick Reeder. Mohammed, first to you, sir, your take on a jobs number from 30 minutes ago.
So I would summarize what Mike covered really well in 3 comments. 1, it is good news for the economy in terms of jobs and pay. 2, it is less good news because labor force participation fell and inflation prospects are still worrisome. And then finally, it is bad news because once again, Fed communication has contributed to undue volatility in markets.
Rick, your take?
Agree with all of that. So I think the one thing that's jaw-dropping, if you look at this number and you break it down, the service sector of the economy, look at 82,000 jobs in education and health services, 88,000 in leisure. The service sector of the economy, which is not interest rate sensitive, education is not exactly interest rate sensitive. The Fed raises interest rates. The goods economy, I would argue, is moderating significantly. I always find the markets focus too much, like in the 80s, when you had a goods-oriented economy. We have 80% of the jobs in the country are service-oriented. And you think about the demand that still has to catch up. You see this in airlines, you see this in restaurants, you see it in hospitality, you certainly see it in healthcare. That's hard to bring down. And by the way, not as interest rate sensitive. The thing that I think is critical is the interest rate adjustment. You see what's happening in real estate. That's having an impact. That's interest rate sensitive. The other parts of the economy, you see, boy, you got it in shining lights today. It's hard to bring down the service economy.
We're going to talk about Blackstone and what's happening in real estate a little bit later, so brace yourself for that. I'm looking at rates right now at the front end of the yield curve. The 2-year at 435. Now, Mohammed, we've got a move today, sure, of 13 basis points, but these aren't even the highs of the week. We started the week, opening up the week on Monday at 445.46 on a 2-year. Mohammed, the reason we're lower on the week still on 2-year yields is because Chairman Powell spoke on Wednesday. Now, you went through this piece by piece in response, in reaction to the jobs number we got 35 minutes ago, Mohammed, and you said this Fed is contributing to market volatility. What is it that Chairman Powell did on Wednesday that you disagree with?
So I said it contributed to undue market volatility. Is the undue part, excessive market volatility. Look, I think once again, the Fed did not understand the technicals. Once again, the Fed didn't understand the behavioral aspects of markets. So while Chair Powell went out of his way to be balanced, he did a few things that made the market hear just what it wanted to hear. First, confirm that we are downshifting in December. Second, do this ahead of the labor report, suggesting that maybe he knew something that others did not know. Third, talk about risks being now balanced, two-sided, and bring in his colleagues on the Fed. And then what he didn't mention, John, he did not push back in any way against what already was a significant rally in markets and a significant loosening of financial conditions. So while he said other things, and he was right to say other things, including warning about inflation staying, warning about our job not being done, he didn't realize where the technicals of this marketplace were, and he didn't realize the behavioral aspects. And that's why you got this overreaction, and now we're giving some of it back.
So, Mohammed, the equity market is basically back to where it was at the end of August when we heard from Chairman Powell at Jackson Hole. You talked about that easing of financial conditions off the back of the speech, the address from Chairman Powell earlier this week. Mohammed, do you think that means they have to go even further than we expect? And based on where you think the terminal rate's going to be, when they deliver projections on December 14th, how much higher up do you think that dot in 2023 needs to go?
So, John, it's going to be tricky. They've got a CPI report just before. It's going to be very, very tricky. I suspect that they will guide us to above 5. That's where I think they're going to be going. But this is really tricky. This is a situation where the Fed has to be very careful about what it communicates, because we don't need undue volatility. And when we come to talk about other segments of the market where there are already liquidity strains, we'll understand why you don't want undue volatility in this marketplace.
June projection for year-end 2023 was 380. September projection for year-end 2023 was 460. When we get the projection, Rick, for year-end 23 in December, is that a 5 handle? How much higher does that need to go?
In terms of the terminal rate?
In terms of the terminal rate, Fed funds 23 year-end in their summary of economic projections.
Listen, I mean, I agree with Mohammed chronicled it. I think they've got to get to about 5-ish. And by the way, I was comment on one part, because last month on the show, maybe I was a bit animated about this because I think it's right. The chair, when he said at the press conference of the FOMC meeting, when he described this dynamic of we can over-tighten and then use our tools to bring it back, and I think I got a little animated. I think that's really hard to do. Unless you break a lot of structures, it's hard to do that. I thought one of the big changes at the Brookings was when he said, actually, we don't want to really do that. That's what some of that volatility was really, because you cut the tail off, and that was a really big deal, i.e. that you could go further and bring it back. That was a big deal for markets. Listen, I would go back to my point. I think they've got to get the funds rate to a level and then let it marinate through the system for a period of time. Put it on hold for a while. It is restrictive where you're gonna pause. And the interest rate tool is one of the most extraordinarily blunt tools today, because it gets at some parts of the economy, not others, and you need to see how it's gonna react. But listen, I think the market's got a little overzealous across a series of things, and I still think they got to go to around 5-ish. But again, I don't think they need to go much further than that until you see the data subsequent to it.
Rick, you've nailed it. The shift from the November news conference to what we heard at Brookings earlier this week. In the news conference at the Federal Reserve meeting, he talked about asymmetric risk. This Fed has basically told us that they think the risk of doing too little is greater than the risk of doing too much. And if they do too much, to your point, they can just reverse it and cut interest rates. There was a shift this week, Rick. And given we had that shift, and given that you've just explained you think we've cut the tails off, do you think the tradable range for the 2-year has shifted lower off the back of what Chairman Powell said this week, regardless of where the data comes in?
So Jonathan, I mean, you're dead right. I mean, everything I get asked at all the events, conferences yesterday, all week, is where are rates going, what have you. I think there's one thing that's very, very different from where we were. I think rate volatility is going to come down, because now we're not talking about 475 basis point rate hikes in subsequent fashion. Now we're talking about, are they going to do a 50? Maybe they do another 50, but they're probably going to get to some 25s. That's a really big deal. I don't think, when you get the 10-year note at 350, as it was pre this number this morning, or even 360 or 370, and you've got a funds rate that's going to be about 5. It's pretty hard to see it rallying a lot from that level. So what I think the big deal, and particularly the front end of the curve, I think rate volatility, that to me is the big dynamic, which has huge ramifications for other markets. If the volatility, the risk-free rate drives volatility down the credit stack, down the capital stack, and if that stabilizes a bit, it's good for markets. Again, I don't think it means big rallies in rates at all. But what I do think it means is a bit more stability than what's been an incredibly tumultuous year because of the risk-free rates moved so much.
If you have more confidence that you can price the risk-free asset, Mohammed, you should have more confidence that you can price risk. I get all of that. The problem we've had over the last 12 months is just how much Fed funds has moved relative to what we expected 12 months ago. Mohammed, you've always said about the need for humility in this cycle coming out of the pandemic. 12 months ago, this Fed had in their SCP for year-end 22, 90 basis points of Fed funds looking at 12 months. Mohammed, as you look out into next year, what do you think we need to be a little bit more humble about?
So first, I think we just have to be humble about how the economy will respond to the lagged effects of what we've already seen. I've warned, look, I'm not where Bloomberg Economics is, it's 100% probability that we fall into recession. But also I warn, be careful. Don't just say, oh, it doesn't matter because it's going to be short and shallow. That's the same trap as transitory inflation. Transitory inflation meant look through it. Short and shallow recession means look through it. No, keep your mind open. The other thing, I completely agree with Rick that we're going to see a decline in rate volatility, but understand that that is happening at higher levels of rates. And that's what you have to balance. Because while the rate volatility will come down, the higher overall absolute level of rates as the Fed keeps on marching up is going to have its own impact on the markets. You know, John, I think we're mostly through interest rate risk. The qualification being the Fed must not contribute to more volatility by saying things that is better not to say. But we're going to talk a lot about credit risk next year and a lot about differentiation both across jurisdictions and within jurisdictions.
Well, you've mentioned liquidity risk several times as well, Mohammed. Can we talk about that a little bit more? Blackstone, I'm not sure how familiar both of you are with this story. I'm going to read out the lead paragraph from our write-up of this story today. I'm going to ask you both to respond to it if you can. Blackstone's $69 billion real estate fund for wealthy individuals said it will limit redemption requests. We're calling this one of the most dramatic signs of a pullback at a top profit driver for the firm and a chilling indicator for the property industry. Mohammed, when you hear that story, and the FT's done a nice write-up of it as well, how do you respond to it?
I'll tell you what I tweeted earlier, Jonathan, which is that this speaks to a much bigger phenomenon. When you run a financial system at very low rates and abundant liquidity, the financial system will optimize those conditions. And one of the ways in which it has tried to optimize those conditions is by offering liquid, relatively liquid products on illiquid asset classes. And we've seen that happen in several places, including in real estate. So when you offer relatively liquid instruments on illiquid asset classes, and the asset class becomes truly illiquid because the financial conditions change, you get what you're seeing in Blackstone. So I think there is a general lesson to be drawn here, and one that we also saw in a different way with the LDI, and we've just to keep an eye. They pop out from almost nowhere, but they speak to exactly the same phenomenon.
Rick, final word here. And does it remind you of 07? Because I've had that thrown around all morning from various people. Does it remind you of 07?
Only tangentially, and I wouldn't comment. I'm not going to comment on them particularly on what happened there. But I will say that there's gearing that happens through the system, as Mohammed said, things that shouldn't be geared. Class B office real estate, parts of the leverage loan market that are dicey in terms of, and you look at how now your interest coverage is declining in some of those spaces. That's where you got to be careful into 2023. The leverage in the system, household, corporate, bank leverage is not like it was, full stop, not even close to where it was in 07. But there are places, and you saw it play out this week, that there are places in real estate, which is, again, why I think the interest rate tool, you got to be careful because it's blunt, and 3/4 of the wealth in the country by people is in the home. And so that's part of why I think, as Mohammed said, get the rate to a level. You got to let it marinate a bit at restrictive levels and then see where we are, because you can do some damage in what is structures that get levered in an environment where rates stay too low and liquidity is too high for too long, and that's the end result of that.
Hey, Rick, awesome to have you with us alongside Mohammed. We're going to find a word from you both in just a moment. Coming up on this program, President Biden avoiding a rail strike.
We're going to get it done, but not within this agreement. We're going to avoid the rail strike, keep the rails running, keep things moving, and I'm going to go back and we're going to get paid leave, not just for rail workers, but for all workers.
The conversation up next, plus reaction from the White House with the Labour Secretary, Marty Walsh, coming up shortly. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It doesn't mean because we are going to pass this, God willing, by Friday, by the time, by the weekend, that I'm going to back off of paid leave. I think we're going to get it done, but not within this agreement. We're going to avoid the rail strike, keep the rails running, keep things moving, and I'm going to go back and we're going to get paid leave, not just for rail workers, but for all workers.
AMH joins us now down in Washington, D.C. Anne-Marie, a difficult decision for the president this week.
Yeah, it is a difficult decision, Jonathan, but he was asking Congress to impose this legislation of a tentative agreement. He struck with the groups and the union bosses and the companies back in September, and the House and the Senate did just that. So the president this morning, in addition to his schedule, will be signing it and giving some remarks at this at 10:15. He was asked about it yesterday, and his take was no one else could negotiate the deal that he was able to negotiate, and that in the end, he got more for workers than they ever would have gotten. But his point is that he's going to continue to fight for paid sick leave, not just for rail workers, Jonathan, but in his words, all Americans.
Can you be the most pro-union president if you're forcing a deal on workers that they didn't vote for? Anne-Marie, down in Washington, great work as always. We'll hear from Secretary Walsh in about 20 minutes' time on this theme. I wanted to get a final word from Mohammed and to Rick as well. To the both of you, I got this over to Bloomberg from a terminal subscriber. I want to share it with you both about the unusually wide dispersion about understanding the health of the economy, the real-time economy, and real-time economic activity. And Mohammed, you often talk about this. To work out where we're going, you have to know where we are. Mohammed, do you think it's difficult to work out where we are at the moment?
It's more difficult to work out where we're going, John, than where we are. And that's because so many things are moving. this is a time of structural change, not cyclical change. And structural change have a tendency of feeding onto each other. So I find it hard. I encourage people not to think in terms of a normal distribution, a bell-shaped distribution with one very likely outcome, but rather think of many possible outcomes and develop plans, because I do think between what's happening in the domestic economy and what's happening in the global economy and where we're coming from and the liquidity regime change, there are many possible outcomes going forward.
Rick Reeder, your take?
So I think that's right. So you take about what does that mean for markets? And by the way, best investors I've ever met and I've been around have humility, as per you were describing earlier. You've got to think through where are you and then readjust as you see appropriate. Today, you can get pretty comfortable parts of the credit market that are higher quality. You can get comfortable in, we're talking about rate volatility, that if we're going to get to a level and pause, the front end, you can get yields of 5%. In some of the AAA assets, you get closer to 6%. Be careful, as you go down the credit stack, as you go down the cap stack, i.e. into equity, you think about margin compression as the economy slowed as top line revenue. You got to be a bit more careful. By the way, that doesn't say not to own some, but I think we're in one of those environments where it's ambiguous as to where we go from a growth, how far the central bank has to go. By the way, not just the U.S. central bank has to go. And so think about where can you get convex return and sleep at night alongside of it. And I think that's the key for 23.
Rick, isn't it great that Mohammed finally showed up for a Payrolls Friday with us? How many months has this been?
No, we missed him. I missed him.
We did miss him.
Well, Rick and I agree, so you don't need me.
We always need you, Mohammed. Stop it. Stop it. Mohammed, it's great to catch up with you, sir, as always, alongside the brilliant Rick Reeder, as always. We've got to keep doing this every Payrolls Friday. The two of them together, absolutely fantastic. Coming up next on this programme, morning calls, and later, Labour Secretary Marty Walsh joining us with the admin's reaction to the upside surprise payrolls report we had about an hour ago. From New York with futures lower, this is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Good news is bad news. It drives us all nuts. I know. Upside surprise on payrolls and equities dropped like a stone. We're down by 1.3% on the S&P, down by 1.8% on the Nasdaq. That's the price action. Here's some morning calls. First up, JP Morgan adding Johnson Controls to the focus list, expecting significant operational changes to fuel the stock's outperformance. RBC downgrading DoorDash to sector perform, noting the company's slowing growth and competition stealing market share. And finally, Wolf Research downgrading Salesforce to peer perform, moving to the sidelines as the company enters a new and difficult period of slowing growth. growth. That stock is down by 2.4%. Coming up, iCapital's Anastasia Amoroso and PGIM's Mike Collins breaking down this market with futures breaking down 1.3%. And later, Secretary Walsh on the labour market report in America.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
About 20-something seconds away from the opening bell. Good morning to you. Equity futures deeply negative. We're down 1.3% on the S&P 500. On the Nasdaq, we're down by 1.8. On the Russell, the small caps lower as well by 1.4%. Data beats to the upside. Equities drop like a stone. Yields take off at the front end of the dollar. A whole lot stronger. There's the opening bell. Switch on the board and get to the bond market. Yields look like this on 10s. Only up now by 6 basis points. The move fades just a little bit on the long end, particularly on 30s. Basically unwound the move. Post payrolls in the last 60 minutes on a 30-year yield, only up there by 3 basis points. The move sticks at the front end just about, up 10 or 11 basis points on a 2-year, 433. That's driving a bit of dollar strength into the euro. And I emphasize, a bit. It's not a major move. Euro dollar, a negative 1/3 of 1%, 104.84. And crude, $81 and about 60 cents. We're positive there by 0.5 of 1%. At the opening bell then, about 30 seconds into the session, let me break this one down for you on the S&P 500 and on the Nasdaq. We're negative by a little more than 1% on the S&P. On the Nasdaq, we're down by about 1.4. With the price action for you, here's Abby.
Well, John, this is a really interesting one because it certainly is not the Goldilocks report that traders have been expecting, but a beat of 63,000 jobs is much smaller than some of the other beats or misses that I can remember in recent times. It shows you how tightly wound traders are because, to your point, we do have stocks plunging. Take a look at the S&P 500 E-mini futures really showing it off the lows, but nonetheless down 1.1%. That index flirting with a possible decline on the week, and the big move in yields. Now, you are right, the long end giving back some of those moves, but the short end, to your point, still up 11, 12 basis points there on the expectation that the Fed will keep on hiking. And for the February meeting now, there's a greater than 50-50 shot that they may actually hike by 50 basis points. So a bit of a change there, weighing on big tech because, of course, a bid for bonds, or excuse me, a bid for yields going higher, price going lower, means that the dollar index is bid up. That's pressuring big tech. Valuation growth really comes into question. Speaking of the dollar, John, it's really interesting because we've had so many folks recently talking about the demise of the dollar. But on this report, there you have the Dixie finding support right around 105. There's a pretty good chance you could see a fast move up toward 108. If that happens, that could really pressure all the risk assets as, again, they become more expensive.
Abby, thank you. To continue the conversation, joining us now is iCapital's Anastasia Amoroso and PGIM's Mike Collins. So to both of you, first of all, just your reaction to the jobs number, which is 60 minutes old now. Anastasia, first to you.
Well, it still shows a solid labor market. And John, as you know, it flies right into the face of what the Fed is trying to accomplish, which is to see the cracks forming in the labor market. And there just are not at the point at this moment. And there's two particularly concerning things within the payrolls report, which is the fact that the labor force participation rate has declined, and also wages is still growing at 5.1%. And again, that's a step up from a prior month. So the Fed, of course, is trying to break this wage price spiral, and it just takes time. So the bottom line, and the reason why the stocks are in the red here, is that the Fed has to get to restrictive levels, and they have to stay there for longer. And what we saw is a repricing in the bond market where rates are now below 5% if you look at the projected Fed funds, and that's just not justified. So that's the repricing that we have to have because of the payroll support today. So I think it's fair. It needed to happen, and clearly it's just going to take longer to see the cracks form in the labor market.
Mike Collins, your take.
Jonathan, I find myself sitting in front of this ominous picture of the Titanic this morning, and I'm really hoping it's not a metaphor for the U.S. economy and the global economy, and I think the Fed funds rate is probably the iceberg, right? And this report is a little disconcerting because, as we've feared, the services sector continues to be really solid. The consumer in general continues to be pretty strong. Services inflation, wage growth continues to be pretty sticky. And this may be a little more of a secular shift than what we've become accustomed to over the last few decades. So I'm worried about, in 12 days when the Fed comes out, Jonathan, with that new dot plot and those 2023 numbers, as you asked Rick and Mohammed. I mean, they're going to probably have a 5 in front of them, right, by the end of 23. And that's nowhere near what the markets are pricing in. The markets have gotten a little bit ahead of themselves in the near term here and are pricing in a lot of cuts at some point next year and ending the year with a closer to 4% funds rate. So it's the markets are a little off sides here.
So Mike, let's build on the markets and just sit on that just for a moment. I wonder whether you think, or would have thought coming into this jobs number, that the sell-off we'd get in equities after an upside surprise would be more proportional to the rally that we got on Wednesday off the back of Chairman Powell. We're only down 0.9% on the S&P. We had a monster rally on Wednesday. If you look at two-year yields this morning, we're only up, I say only, by 12 basis points on a two-year, and we're not even at the highs of the week. In fact, we're about 10 basis points off them on a two-year at 435. And as we often say, Mike, you can learn something from the data. You can also learn something from the way the market responds to that incoming information. What are you learning from this morning?
Yeah, what I'm learning, Jonathan, is the markets maybe got a little bit ahead of themselves. I mean, when that 10-year kind of dipped below 3.5%, and you're going to be in a world where the funds rate is going to be at 5 not too long from now. Now, that's a really big stretch, right? So we're kind of fading that. And equities, I would put in the same category, maybe got a little bit ahead of themselves here. Credit is probably in the same boat. Spreads have had a huge rally here. We're generally fading these rallies across all of the assets, but you don't see a big sell-off here because this wasn't a huge number. We didn't see a giant miss here. I mean, it just shows that the economy is okay. It's not falling apart, at least in the U.S. The job market is solid, right? We have a shortage of workers in the world, Jonathan, right? And that's going to keep wages sticky, keep job gains pretty good. Companies are really reticent to let go of all these workers they've been fighting to find. So I think it's a little different world than we've been accustomed to, and earnings have kind of held in. So yeah, I mean, it's I think this whole soft landing, mild recession scenario is probably increasing in probability.
You've said that a lot over the last couple of months, Mike. I've heard you say it a few times. The resiliency of this economy, Anastasia, has surprised many. You've got the front half for 23 as this part of the calendar where you think there's going to be a better entry point for equities next year. Anastasia, what is it about the front half of 23? Because we keep hearing the same thing from a lot of people about the same time.
Right, John, as I think about these markets, I mean, we've been in this sitting and waiting and wishing mode, and we've been wishing for inflation to fall down. We've sort of been also wishing for the slowdown that we've all been anticipating to finally happen. And I do think that is very likely to happen in the first 2 quarters of next year. I mean, typically you think the yield curve inverts and, the Fed ends the rate hiking cycle, and there's still some time before the onset of a recession. But what's different this time is typically the Fed doesn't hike into a slowdown, but they've been doing this all along since June of this year. So, Jonathan, I think this recipe for recession has been in the making for quite some time now. It is really kind of ready to be fully baked here. So if you look at the economic projections, we're expecting slightly negative GDP growth in Q1 and Q2. And so Q1 in particular could be problematic because, you can have the economy that's notably weakening. I mean, we already had the manufacturing gauge slip below 50. So you have an economy that's weakening, but the Fed, to Mike's point, they're not going to stop hiking rates just yet because of service inflation. I absolutely think 5% is going to be in the dot plot in December. So we're going to get to 5% rates and the economy is weakening. That is not a good mix of outcomes for the market. So that's why I think it's very likely that we'll retest this 3,600, if not below. But as I think we move further into Q2, that's when this gap is likely to open up between where the Fed funds rate is, which should be at 5% or maybe north of that by June of next year. But the inflation, the core PCE inflation, I suspect does begin to come down, and projections are for 3.8%. So we finally going to have this gap where the Fed is actually well ahead of the inflation curve. So when that gap opens up, I think that's when they will eventually pivot. So that's why the first half and the first quarter in particular is likely to be treacherous, but that is likely to be the entry point into risky assets, because once the Fed has the gap, that's when they'll be ready to pivot, and that's when risk assets can finally catch a break.
Why aren't we pricing that now, would be my question, Anastasia. I hear it from you, from UBS, from JP Morgan, from Morgan Stanley, that first quarter is where we get pain. Now, as Lisa mentioned earlier this morning on surveillance, this is meant to be an anticipatory asset class. Why aren't we discounting some of this stuff right now?
Oh, it's still so far to go, John. I mean, patience here is going to be a virtue, and this is still a 6 months out sort of an event. And I think that's why the markets have been trying to discount some of that, but this is a very tactical market. I mean, you really can look out, a couple of weeks in advance or maybe a month in advance. And, what everybody I think has been discounting now is the Fed is likely to slow down the pace of increases. And by the way, I still think that's going to be the case in December, 50 basis points, despite the payrolls report. But what comes after that is still quite uncertain. So it's just, the crystal ball is not all that clear 6 months away. So it's far too early to discount that.
And Mike Collins, final word here.
Yeah, to Anastasia's point, the markets, Jonathan, to be clear, are pricing in that soft landing, right? They're pricing in the worst case, kind of a mild recession. They are not pricing in this more draconian downside, harder landing scenario. And even though I don't think that's my base case, man, there is a reasonable probability that the Fed screws this up again, that a 5-handle funds rate is way too tight, in conjunction with a tightening balance sheet, and that the whole thing ends up rolling over much harder than we expect. And earnings expectations are still way too high for next year. And you have a deeper, harder landing next year. That is not being priced into the markets, which is why we're kind of fading risk assets here.
Mike Collins and Anastasia Amoroso, to the two of you, thank you. And Mike, special thanks to you, buddy, for waking up early on the West Coast. Thanks for doing that for us. We appreciate it. They're going to stick with us. Coming up, hiring and wages keeping the pressure on the Fed.
It is good news for the economy in terms of jobs and pay. 2, it is less good news because labor force participation fell and inflation prospects are still worrisome. And then finally, it is bad news because once again, Fed communication has contributed to undue volatility in markets.
The brilliant Mohamed Al-Arian earlier this hour. Equities down about 1%. Coming up, we get the view from the White House with US Labour Secretary Marty Walsh. Looking forward to that conversation up next.
Policy, politics, from the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Live on Bloomberg TV and radio, I'm Jonathan Ferro. I'm pleased to say that joining us now from Washington is the US Labour Secretary Marty Walsh. Secretary Walsh, fantastic to catch up with you, sir. Another strong jobs report. As you know, this has been a very, very strong labour market in America, and Labour is meant to have the leverage in this world. And Secretary Walsh, we've got to go to the union question. Should unions have the right to strike?
Absolutely, unions have the right to strike. I think unions have the right to strike in almost every collective bargaining agreement. In this particular case, your next question will probably be about the rail, so I'm going to anticipate it. The National Railway Act has a provision in it that allows the president to get involved in negotiation when asked, and the unions asked him to get involved in this. He put together a presidential emergency board. They came back with some recommendations. I had that 20-hour negotiation in my office. We added some more benefits to the contract. It went in front of the members. 8 of the unions voted for it. 4 of the unions voted against it. I tried to get both sides to stay at the table and negotiate over sick time, and there's some work condition rules as well. They weren't able to get to an agreement, and the next step in the Railway Act is Congress to take action, and that's what they did yesterday.
Well, I'm pleased you anticipated it, because you said it all at once for us. On the one hand, you think they should have the right to strike, and on the other hand, you take away their right to strike. Can you make sense of that for us?
Yeah, well, I mean, it's the way the law is, the Railway Act is. And, you know, when I look at this contract, we spent a lot of time, I spent a lot of time myself, but the unions in particular, spent a lot of time at the negotiating table. And there's some very good provisions in the contract. It wasn't like it was a bad contract. 24% increase, 85-15% split on healthcare, which they preserved. They were able to get some work rules changes. They were able to get 3 unpaid days off. The issue of sick time needs to be, the companies need to sit down with the unions now and have a serious conversation about 2 issues. One is sick days, paid sick days, and the second issue is manpower and power on the work, on the rails. They're down about 30% over the last several years, and that's a big issue when it comes to the safety and health of the workers on the job. So I'm going to encourage both sides now to get right back at it and have those conversations now and move forward in a positive way.
Secretary Walsh, there is a key distinction, an important distinction to make here. It is the way the law can work. It's not necessarily the way the law has to work. You've chosen to make this decision, haven't you? This was a choice.
Well, I don't necessarily. I think there was a lot of factors here too. You're talking about the economy, and you're talking about supply chain, and we've had challenges in our country with shortage of baby formula. We've gone through a pandemic where we had shortage of supplies coming in, and what this would have done to the American people, never mind the American economy, it would have crippled a lot of people because we wouldn't have food. It would have shortened food on the shelves, supplies coming in. This is also as much of making sure that our economy and the American people move forward than anything else too. So again, I'm very sympathetic to the workers out there, and that's why the president, when he, at their request, put the Presidential Emergency Board together, came back with a very good recommendations on behalf, not everything, but in negotiations. I've negotiated contracts where I've gotten good contracts. I've negotiated contracts where I haven't gotten everything I've wanted either.
Paid sick leave, it's something you have, it's something that I have. How can those railway workers ever secure the benefits that you claim to support without the credible threat to strike?
Well, I hope you have the companies on this show and ask them that same question and not ask me today after the Congress took action yesterday, because I think that's a very important question. You need to ask the companies why that's not offered to their employees across the board. But in saying that, I intend on sitting down with the companies and talking to them about a couple of things that during the negotiations that I heard from the unions about the concerns that they had about their workers have, and I intend on bringing that up and talking to them about it. And the next contract, this contract expires 2024, so they're already working 3 years without a contract. So as they head into the next negotiation, this should be the top priority. And you don't have to wait for a negotiation. The companies can offer up paid sick time anytime they want.
Oh, you've just made it even easier in the next negotiations, though, haven't you? Because we know the end game here. If you're on the other side of that deal, that negotiation, Secretary Walsh, why on earth would a company sign up to any of that stuff when we know what's going to happen here? Ultimately, they can just say no, and then it comes to the president, and the president says, okay, we'll impose this deal on you.
No, you know how negotiations work. That's not how it works. I mean,
I've just seen how it's played out, sir, in the last couple of months. What do you mean that's not how it works? That's how it's played out.
That's not how it works. The Congress has interacted over 18 times with a PEB recommendation. In 1992, they recommended a PEB. Congress enforced a PEB that was not pro-worker at all. It didn't have wage increases, didn't have preservation of health care premiums, it didn't have work conditions, it didn't have unpaid days off. It didn't have any of that. And Congress came in. And again, this stuff has to happen at the bargaining table. And that's why the companies need to come to the bargaining table a lot earlier. In this particular case, they didn't come to the table till I think 18 months after the contract expired.
And they won.
We've had the, no, they're going to have to. I think that they you know, a lot of the CEOs have made comments already about the need to better relations with their workers in the unions on their jobs.
Secretary Walsh, you and I can go back and forth on this a lot. The President of the United States intended to be, quote, what he said, his words, the most pro-union president leading to the most pro-union administration in American history. The fact of the matter is, when it came down to it, you forced union members to take a contract they didn't vote for. How do you explain this in any other way, shape, or form? I just don't understand it.
The President of the United States of America is very pro-union. There's no question about it. He talks about it very publicly, and he's very proud of that. He's also the President of the United States of America. And when you look at what the devastation a national rail strike would cause America, that far outweighs the cost of moving forward. The President put together a PEB. There's a lot of benefits in that PEB, good provisions in that PEB that are going to benefit these union workers out there, and there's no question about that. I'm a union worker, a union member myself. I understand that. And at the end of the day, the President got a very good deal on the table for the workers. However, the workers wanted more in that deal, and I can understand and sympathize with the workers. But what we'll do is we're going to continue to work now as an administration to make sure that we help them achieve their ultimate goal.
What message do you think this sends to the ongoing labour contract talks with West Coast dock workers? Secretary Walsh.
I mean, the West Coast dock workers, they're in current negotiation, and they have their own bargaining issues that they're working on, and they're moving forward on that issue. They're having those conversations, those dialogues. The difference is the companies in the dock workers came to the table at the beginning of the negotiation, not halfway through it.
You've been quite constructive on how these talks will go on the West Coast. What are the lessons learned, Secretary Walsh, from the last couple of months with the railroad workers, where you were also equally constructive on how this would turn out? What are the lessons learned for you personally over the last several months?
Unfortunately for the rail unions, I didn't really get involved until pretty much they were 80% through negotiations, meaning they were not able to get deals done. I got involved a little bit there. Then the unions came and asked the president to put the PEB on the board, and they were able to negotiate stuff. And on the port negotiation, I've been in it from the beginning, meaning I've had conversations with the companies. I'm in regular contact with the companies on the West Coast. I'm in regular contact with the unions on the West Coast, just to make sure that they're moving forward. And I think that the relationships are a little different than between the rail construction, the rail companies and the rail workers unions.
Secretary Walsh, I know you have to go, sir, because there's a bill to sign with the President of the United States at 10:15 Eastern Time, and you've got to run. We always appreciate your time. Thanks for being with us this Friday morning. Labour Secretary Marty Walsh, following what was a tremendous jobs report. Mike McKee's alongside us, and Mike, I want to talk about labour leverage. Do we have the leverage in this labour market that we thought we were going to have, Mike, this year?
Well, to a certain extent, we have more leverage than ever, or at least in many decades, because right now we're seeing average hourly earnings rise significantly still because employers can't find workers. 10 million jobs still open, and that means that if you're in the labor market and looking for work, you can generally get higher wages. The numbers that have been calculated by ADP and by the Atlanta Fed, 6 to 8% increases per month to get people to come to work, and we saw that in the wage numbers today.
Seeing this headline as well, crossing about 10 minutes ago, JP Morgan, Bank of America, Citi, slashing banker bonuses, the talent war ending on Wall Street. We're going to have a ton on this later in the day for you on Bloomberg TV and on Bloomberg Radio. Up next on this program, we'll run you through the trading diary about 23 minutes into the session. Equities on the S&P off the lows, but still down a little more than 1%. From New York, this is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
25 minutes, almost 26 minutes into the session. Equities down about 1% on the S&P, on the Nasdaq down by 1.5%. Moving the bond market phase just a little bit, but the story's still clear right now. Payrolls upside surprise and equities lower. Good news is bad news. Let's see if this sticks. Let's get you the trading diary. Coming up, President Evans of the Federal Reserve speaks at the top of the hour. And it's the quiet period for the Federal Reserve. President Biden, a little bit later, in about 20 minutes from now, he's going to sign that bill. An OPEC Plus meeting on Sunday. Looking ahead to next week, US PMIs and ISM data on Monday. Another round of jobless claims on Thursday. PPI later in the week. Then the big week, the week after. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Have a wonderful weekend. This was the Countdown to the Open. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look. in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in a hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I'm interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter. It's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your
life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwist, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
the GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations.
Connection lost.
I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero. I aim to be a top-notch engineer. I am a Swero. I aim to be a top bureaucrat of this country. I'm a Swero. I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of spheroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We got a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again try to excel in academics day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green-growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planted terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy, Austin John.